which we will release today. So as a background, first of all, we have our team back there. It's not just me, it's not a one-man show, this is a collaborative effort from the entire team, and they are all at the back there representing respective expertise. So the background of this report is as such. One is that we were supposed to publish this much earlier, but because World Bank and IMF came up with an update on the 17th of January, and it's not usual for the World Bank and the IMF to come to a refresh report on the same day. And more often than not, we saw IMF usually present their report in somewhere in October, whereas the World Bank somewhere in first week of January. But this time around things are different. Hence, everything else is also being delayed as a result of that. And we are also confronted with our festive seasons too, because Chinese New Year is next week, and so everything is pretty much compressed. So all of us are losing hair or turning grey as a result of that. So basically, this will be my presentation this morning. First of all, we will talk about the overall perspective. I will try to give a snapshot about the global economy, how we see the global economy in 2025, and we will follow with the major economies. We will talk a bit about the US perspective and the Eurozone, as well as China. Now, why these three things? Why these three economies? Because these three economies are, one, our largest trading partners, and more importantly, they also have quite a significant influence in monetary policy, which, as a bank, that would affect pretty much our perspective overall as well. And then we'll move to Southeast Asia. We will look into ASEAN perspective as well, because things are actually pretty good for ASEAN. Surprisingly, really resilient. And we foresee that things will continue, and I will explain more about that as well. And finally, the sexy bit of the presentation is, of course, Malaysia, how we see Malaysia in 2025, and you know, to give you a bit of snapshot about what we see that will unfold in the 12 months or so. Please come in. We have just started the introduction bit, so you have not yet missed anything. Make yourself comfortable. There are refreshments outside, so you know I'm trying to make this as cordial as we possibly can. Right. So this is everything you need to know this morning. So this is just a snapshot. Oh, by the way, we will send you the soft copy of the presentation. The report, and you can connect to Shikin. Shikin will send you the soft copy of the report if you need that. So basically, this is the whole idea of the report. We are looking at 4 things, and these are the 4 themes. And the 4 themes are as follows. We will look into food inflation, which we think that is going up as a result of higher CPO prices, mostly vegetable oils. And as a result of that, things are actually moving higher. Average global inflation, now according to IMF, inflation is unlikely, will likely to stay elevated, and it will probably persist throughout 2025 and perhaps even longer. Global trade we see an uptrend, and it will probably be choppy moving forward because of the disruption of the different governments having different policies and announcements. But it seems to be an uptrend, which is a good thing. And another thing that aids the perspective about global trade is also the supply chain, where the supply chain is no longer how we saw in 2022 and 2023, and so on. Now, the interesting bit about the supply chain is that even with the disruptions around the world, the geopolitical crisis in the Middle East as well as in other parts of the world, so it is very low, and it's quite interesting as well. Global oil prices, now yesterday at Davos, US President Trump mentioned that he wants, according to him, to have a lower global oil prices. And so far, we are looking at around mid-70s, but it will gradually go down as we move towards 2026. And this is pretty much in line with what we had in mind as well. Global interest rates, we think that it's going to be less aggressive as we saw in 2024, because it was, in the past, it was all about addressing the raging inflation. So that inflation narrative is no longer in the picture, now is being moved towards growth perspective. So that's about the global economy in a nutshell. Now about major and regional economy. Now, like I said, we are looking into three largest economy, which is the US, Euro area, and China. So for the US, we expect things to be still strong at around 2.4 to 2.2 to 2.4 in 2025, based on IMF or World Bank estimates. And coupled with inflation trending sideways and probably going down as we move along. But we think that there is an upside risk for inflation if things were to unfold quite aggressively as we move along. And about Euro area, it's all about growth. Now inflation is not really a critical concern for the Euro right now, other than the services inflation. Now services inflation has been quite an interesting perspective from the perspective of the Eurozone. And the reason for that is, wage growth is still very much good in that part of the world. China, all major central banks, which I will touch a bit later, are not going to see China growing at 5%. It will probably be somewhat lower than 5%. We think that is possible because first of all, inflation is still very low. Consumer sentiment, consumer confidence is low. Retail sales in China is also it's trending sideways, but it's not bad. It's just that it's trending sideways, and it's unlike we saw in the middle part of the past decade. Monetary support will continue. They will probably to make it very supportive this time around, and I will delve deep dive into that later on. Southeast Asia, I've already mentioned. So this is pretty much what we think about the regional economy and the major economies. Now for the Malaysian economy, our in-house forecast for 2024, we're looking at 5%. For 2025, we're looking at 4.6, and 4.4 the year later. Inflation, we think that it's going to fall somewhere around 2.5%. Now there is an upside to that, and we think that it will probably range from 2.5 to 3%. Now, historically, that is pretty much within that range. It's just that last year we saw that inflation came in much lower than what we anticipated in the earlier part of the year. But in any case, our forecast for 2024 inflation was spot on at 1.8%. OPR, we believe that it's going to be flat, which I think that Bank Negara has no appetite to act on rates right now. And because of the domestic economy consideration, it's still pretty much solid. And we don't see the pressure coming from internal. In any case, it will probably be a more holistic view about how OPR should act rather than anything. But we're looking at 3%, and we will assess how things go as we move along. Fiscal, for the fiscal perspective, we think that the government's plan to reduce fiscal deficit to 3.8% last year, and in 2025, and for last year it will probably be somewhere around 4.3%, is pretty much attainable. Now this is despite what the economic conditions that we have, and we think that it's pretty much on track so far. Right, so fixed income and FX. For USD MYR, ringgit, we think that it's going to trend sideways, and it will probably fall at 4 ringgit and 45 cents by the end of the year. Now it's trending around the same level, so but it is not a straight line, just mind you. It's not a straight line, so there will be variations, there will be volatilities because of the perspective, or rather the volatilities coming from the external environment, but that's our forecast for now. For US dollar, we think that the value of dollar will hold up quite okay, and will continue to be trending above 100 points for now. Well, Trump doesn't really like strong dollar this time around, so now it's trending about 108 at the upside of 109 since early January, but we think that it will probably be somewhat lower as we move along. but it will still be around 100 points. MGS, we think that the supply of MGS will be around 165 billion this year, and net issuance for MGS is 80 billion, which is pretty much in line with the development expenditure of the government. So that's pretty much what you need to know today. But let's go deeper. Now, looking at this chart, again, the updated number from the IMF and World Bank are here before you. So what I want you to see here is that the World Bank, once again, has a pessimistic view about the global economy, unlike the IMF and the OECD. For 2025 and 2026, you will notice also that the IMF and OECD have a somewhat similar stance about the global economy and the performance of the advanced economies as well. But also an interesting point from this table is that none of the MDBs, including the Asian Development Bank themselves, believe that China will grow at 5%. It will probably be somewhat at a 4% level, but India will still continue to grow quite strongly at above 6%, around 6.5 at least, in 2025 and 2026. And that is pretty much how the multilateral development banks are looking into the major economies and the global economies in 2025 and 2026. So as I mentioned earlier, food prices are going up, as you can see here, at the global stage. It's predicated very much because of the vegetable oils. So if you look into the breakdown of this, and you would notice that the oil part, which is the black line, is trending higher. Dairy is coming down, but still pretty much elevated. But everything else is still okay. So the point is about vegetable oils. Now, one thing to note is that when around this time, late last year, CPO was trending at 5,000 per ton. Today it's 4,500. If all global oil prices would come down, it is likely that CPO prices will come down too. So we think that it is likely to go down with circa 4,000 level, and this will in turn will reduce the food price inflation at the global stage concurrently. Global inflation I've already mentioned. And global trade, you see there's a lot of volatilities coming from global trade. It goes up and down, but it is upward trending. So this is a good sign for Malaysia, in fact, because one is that as an exporting nation, the strength of the US economy means that we will continue to have a good access to the US market. And in fact, we are restarting the Malaysia-EU FTA, which is one thing that I have been personally, I'm very much invested in that, and the reason for that is because the EU remains, despite the challenges, still the second largest importer of the world. Supply chain pressure, I've mentioned that, and see the Brent crude prices are trending lower, and it's moving towards eventually will go towards the 60-ish, low 60-ish per barrel mark. So now let's move to US. So like I said, growth is still very resilient in the US, despite raging inflation, higher for longer, and very tight labor market. Everything else still they are growing at a very handsome performance. Now the Fed funds rate has been reduced quite significantly. You see that there's a big fall here because of the 50 basis point cut in September, and then subsequently another 25 and 25. So bringing the Fed fund rates lower by 100 basis point last year. Now the US dot plots, the latest December dot plots suggest there will be about 2 cuts, about 50 basis point lower, which we think it's possible, and we are pretty much in line with that narrative for now. US unemployment rate, although it has been trending higher, now this is probably the reason why the Fed cut aggressively, because the conditions of the labor market in the US is no longer what we saw in 2023, at least in the early 2023. So it has been trending higher, but things are actually stabilizing at around very low 4% mark, which in historical terms is quite a feat if you think about it. Labor data seems to be okay, and the ICJ, the initial jobless claims, IJC, sorry, is still very much in line with forecasts, and things are actually looking pretty well as far as the labor data is concerned. And you notice there's also a small uptick here. That means there is some resilience coming from the US labor market. But we see speed bumps in inflation trends. Now, notice that while the 2% target is still on track from the US perspective, in CPI, if you look at it from CPI, it's still trending at 2.9, but the services inflation is still very much higher compared to core and headline CPI. Now, here's the thing: as long as the wage growth is positive, then the services inflation will continue to be higher, trending higher, and that's what we're seeing here. So for PCE inflation, it is a different mechanism, or inflation tracking from the CPI. It is pretty much in line with CPI as well. Producer price index is going up in the case of the US. So in the latest reading came in at 3.3% in December. But maybe with the US administration, the new US administration outlook, things will probably be either flat or coming down, maybe moderately as we move along. The euro area, while if you see here, it looks like it's going up, but it's at a very, very low level. It is sub 1% level. So growth in euro area is definitely a concern. Consumer inflation, as I mentioned, services is very much elevated, but although headline has inched up a bit, but it is not something that we are overly concerned about, and that is because towards winter, there will be a higher energy demand, and that's not really a concern as long as it is very much under control. Unemployment rate in historical terms, although it looks elevated at 6.3, but in historical terms, this is quite tight for an economy in Eurozone. Interest rates, I think US, we think that the Euro area, the ECB will take a very measured approach this time around in 2025. And the reason for that is pretty much predicated on growth. It's not so much about inflation. If the inflation narrative will likely come in from the elevated conditions of the services inflation in the Euro area. Wholesale and retail, which is very much in line with the household consumption here at the red line, is actually very low from the wholesale and retail perspective. China, as I said, the multilateral development banks don't think they will achieve the 5% mark, while inflation will likely to trend low for very, very long. Now, if you see the way how China inflation trended during Trump 1.0, it's pretty much the same. So it moves in an opposite direction. So when inflation goes up, then there is a tendency for inflation in China to counter or rather experience inflation more. So you see here that the red line, which is the CPI, is trending lower, and the PPI, the producer price index, has been trending in a negative position at least since November 2022. PMI, however, still managed to fall above the 50% mark for now, and we think that would probably be a point where it will try to be trending sideways at least, and as China move into the inflation mode in 2025. Consumer confidence is low, you see that retail sales of consumer goods is trending lower at 3%. Residential buildings sold in China is getting lower and lower year by year on a cumulative basis. And but on the flip side, we see that the unemployment rate is pretty much flat at 5%. So in any case, we think that, as I said earlier, the Chinese monetary policy will try to be as supportive as possible because of this narrative and because of consumer confidence. But the good part is that Chinese trade performance will likely to trend higher, so long as the US economy is still going to sustain its resilience in moving forward. And if there's no massive policy shifts coming into China. Now, more often than not, we will look into what what happened during Trump 1.0 and to see some clues into what will happen in Trump 2.0. Now, we will likely see similarities, but it will probably not be at the same magnitude that we saw during Trump 1.0. And the reason for that is that during Trump 1.0, it was pretty much, if you think about it, it was all about dispersing Chinese investments. Now, after China was slapped with tariffs during the starting January 2017, so we saw Chinese investments going abroad, mostly to ASEAN and other parts of the world, including Mexico and Canada as well. So now it's not just about containing China, but maybe the idea is going to be different. We do not know yet, and I think we will continue to monitor this as we move along. But it is not, while there will be similarities, but we don't think that it's going to be the same as what we saw during Trump 1.0. Southeast Asia, things are actually looking very well, at 4.5%, sorry. But ADB is slightly optimistic with the region's growth at 4.7%. Barring the projections coming from the IMF on Singapore and Vietnam, IMF in fact upgraded Malaysia's growth from 4.4 to 4.7 in 2025. Now this is a good thing because it shows that the Multilateral Development Bank, namely the IMF, have confidence about Malaysia's growth in 2025. And that is something that we should also be mindful of and be proud of, in fact. Now, from the perspective of ASEAN inflation, things are actually moderating. We don't think inflation is a big cause for the region. In the case of, say, Thailand, for example, they've been trying so hard to push inflation higher, but inflation in Thailand continues to trend below their target. And the same as others, the only economy in Southeast Asia that is with inflation that is trending within the comfort level of the central bank is the Philippines. Everyone else is trending lower, including Singapore, including Malaysia, and others in the region. But the pressing one is Thailand. So let's go into Malaysia. So this is the snapshot of our projections for the year, both by expenditure and by the supply side. So just to give you a snapshot, we think that public-private investment will continue to be strong at 8.4% this year versus a double digit in last year. So this will likely sustain. Will buttress Malaysia's growth in 2025. From the supply side, we see construction going double digit last year, and again, we think that it's still going to be a commendable growth for the sector in 2025. Inflation, I mentioned, unemployment rate, we think it's going to stay flat. OPR 3, yep, that's pretty much our outlook. So in the report, we also mentioned, or we also take stock about what happened during Trump 1.0 and why we think that private investment will continue to be strong in Malaysia in 2025. Now, during Trump 1.0, even though there was a trade diversion of sort, coming from Vietnam to the US, we saw that trade coming from Malaysia has been quite resilient in that manner. And from the investment perspective, even during the FDI inflows during Trump 1.0 from January 17 and so forth has been relatively resilient during Trump 1.0. And it's quite, well, discount things because this was during COVID, but after COVID we see things moving back or trying to move back to where things all started. So right now we think that Malaysia is undergoing an investment upcycle, driven by private investments in data centers and other manufacturing activities, car assemblies, and we think that momentum will continue in 2025. Trade, however, while we saw good growth last year, so I think we think that good growth last year is also because of the front-loading effects. When traders were anticipating Trump tariffs in 2025 and beyond, so there was a front-loading effect, I think, but it will be somewhat resilient moving on in 2025. Private consumption seems to be okay, although there is a small drop, but we are not entirely concerned about that. And that is because we think that private consumption is normalizing in the post-pandemic era. So retail sales and private consumption is still going to be somewhat between 4 or 5% moving on and so on. Unemployment rate, so since we are becoming an aging nation, or we are actually in that process, so labour force participation rate will continue to be elevated above 70%. And we think labour market in Malaysia is still okay. Now inflation is going to be quite an interesting thing to watch because one, subsidy rationalization on RON 95 is slated to take place in the second half of this year. And also electricity. So here's what we think about it. Now, what we saw last year was diesel subsidy rationalization of diesel. We initially thought that inflation would spike to a level that we saw in the earlier part in the mid-2010s when the government rationalized diesel and petrol back then. So we thought that the same scenario would happen. It did not happen. In fact, it was actually a surprise to us, to a large degree, that inflation did not misbehave when diesel subsidy rationalization was initiated. So, what will happen to RON 95? We think that it will probably be in the same manner. So, in the event that the government were to initiate this, we think that the impact on inflation is going to be very much controlled. So there are many reasons to support this notion. One is that global oil prices will continue to trend lower, and it is trending lower as we speak anyway. So that is one. Second is that we noticed that the mechanism or the idea between subsidy rationalization today and what we saw in the previous administration were also different, in a manner that in the past we were looking, or rather the government, we think, this is what we assess, is that the government was looking to rationalizing subsidies and to match it closer to the market rate at whatever implementation. But now I think the idea is that to do the same without having a strong impact on inflation, and that's the difference. So that's why we did not see inflation misbehaving as they should last year. So for RON 95 will probably be in the same manner as well. OPR, we already mentioned that. Okay, here's a snapshot. So we think that the ringgit will end the year at 445, euro at about 104, pound sterling at 126. JPY is going to be interesting. Now, why I find JPY is interesting is because maybe the era of low inflation in Japan has done. It's no longer there. Inflation in Japan came in at 3%. they are not used to it. You know? And for the longest time, their interest rate has been trending at very, very low, in fact negative. And only in the last couple of quarters that they start to think about how to normalize rates and to match to the new scenario. Now, while we think that the inflation narrative will come in from Japan, but at the same time, they have growth problems too. So it will, again, if you notice that it's all about growth here, it's not so much about inflation as we move about. But for JPY, we think that it's going to be around 150 level by the year. CNY, 734 by the end of the year. But in any case, with the sentiment coming from the US, the safe haven narrative will continue. The US dollar buying sentiment will also continue. And it is quite interesting that when things are bad, US dollar is good. When things are good, US dollar is also good. Okay, so this is what we think as well. Ringgit is trying to trend sideways with variations. But what I want to point out here is that the RIA is really at the 100-point level. But there is an upside for the ringgit because our growth is still healthy at 4.6 in 2025 and comfortably above recession, unlike any other market or any growth headwinds we saw in other regional markets. Bank Negara will slightly to stand pat as well with the perspective of the narrowing interest rate between Malaysia and the US, and that will also be one thing to consider as well. Recovery in exports, as I mentioned earlier, and ringgit, we think that in a long-term basis is still undervalued, and as well as the wildcard is that if ringgit will improve if exporters were to repatriate their proceeds quite strongly now as what we saw in last year. So bond yields perspective, this is what we think will unfold because of the narrowing interest rate and yield gaps. So the narrative things will somewhat different this year compared to last year. But we foresee ringgit bonds to continue to benefit. And the perspective of the government continuing with fiscal deficit too, and supply will likely to be smaller with gross issuance of 165 billion this year. We think that the demand for ringgit bonds will continue to be somewhat firm moving on. With a static interest rate environment, at least from the perspective of OPR, that will be quite a good pointer for the bond market. Okay, I think I've probably talked a bit, but just to show that our forecast is different from before it was made in the last elections, US elections. So it's now somewhat elevated, somewhat higher at around 100 basis point higher. But the point is that as US CPI were to come down, so the pressure for the Fed to reduce interest rate will also come down, and things will spill over to the Malaysian market as well. Okay, I think that's it. I hope I entertain you as much as I can in the last half an hour or so. So I'm free to take any of your questions.
Anybody has a question? The first question? From the edge.
Hi, hello, good morning. I'm Kuman. Earlier in your presentation slide, you mentioned that at least for the central bank to maintain, to stand by their OPR at 3%. And you were forecasting that 3% to stay until first half of 2025. And likely
at least.
At least. And then what's the reasons beyond the first half, during the second half of 2025, you're expecting the benchmark to decrease? And what will be the reason for that?
Well, for now, we think that OPR will. We do not see the Bank Negara having the appetite to act on rates because the necessary conditions for for the OPR to stay at 3% is still there. The reason why we put that it is at least first half of this year is to show that the confidence that we have that OPR will stay at 3% for longer than it should. So that's the reason why we put at least 3%. But in any case, we think that will continue because the necessary conditions is still there. To name a few, civil service salary review. It's not just going to be, it's not just happened in December last year, but there will also be one in January 2026. Progressive wage model, the minimum wage level to go higher from 1,005 to 1,007. So the necessary conditions is still there for OPR to stay at 3%. And besides, the perspective of the narrowing interest rate as well is good for the ringgit, to say the least. So that is also another perspective. But the idea here is to show the confidence that we have that OPR is going to stay at 3%.
And then that forecast is for the first half or for all the...
No, we are looking at 3% throughout, but we are confident with 3% in the first half. So basically that's it. Yes.
Issue procedure dating, but based on your report, I saw that your forecast we start to rate cut in second half.
Well, so in any case, if rates were to move, it will not just be about to hike or to move down, and it's not just about the conditions about the domestic economy, but it's also about the global economy as well. But looking at the MPC statement coming in a few days ago, that it seems that there is more confidence coming from Bank Negara that there is no urgency to act on rates. So that's what we notice, and that's why we think that OPR will continue to stay at 3% in the first half of this year, and if the private consumption and the labour market continues to stay good, then it will likely to just go on to 3% throughout 2025.
But the forecast rate cut is still to the risk on external, or because internal we got no problem.
Focus for the rate cut.
Yes, I think in the report they mentioned will be rate cut. Oh no.
Okay, while you're going through that, are there any other questions?
Just a follow-up on the OPR, because I think the BNM tones about the domestic is a little bit neutral, but at the same time the BNM was also in the statement saying that there must be some uncertainty in terms of referring to the global risk and then also the domestic risk. So what do you think about that one? What do you think that it will be influence the OPR situation?
Well, so the uncertainties will continue. I mean, instead of to put a picture here, instead of US President Trump were to give a blanket overview about what he does, it seems like things are moving rather stagnantly for now. So that will continue to be, I think the whole world will continue to play catch up, as we move on with this narrative of the staggered announcements. And as a result of that, that's why we think that what Bank Negara put in the statement is pretty much in line what everyone else has been thinking, is that there will be uncertainties, there will be volatilities. But in any case, the domestic conditions are still good. You know, like I said, you know, private consumption are still normalizing at a good rate, and then the wages will continue to go higher. Unemployment rate is still okay at 3.2%. So that's why we think that, you know, while there will be volatilities, but the conditions for OPR to stay flat is there. Yeah, so what we are saying here, if it's not clear, is that so if growth were to be, or growth headwinds were to come in at a rate that we cannot anticipate today, so if it come in quite strongly, then there will be you know, the conditions are different.
I think the Trump state, just like I mentioned, that we need to continue to monitor the situation from the US side, right? The policy.
Yes.
I think that's one of the more external risks. Maybe will hit Malaysia, the economy.
Yeah. But then again, as let me reiterate, the domestic conditions for OPR to stay flat at 3% is there. It's just that, you know, that line is just to show if things go above and beyond of what we cannot see today.
But there's possibility lah. Maybe the external risk we don't know yet.
We don't know yet. I mean, we know that Trump is Trump, you know, but we just don't know the magnitude for now. But then again, it all falls back to the conditions of our domestic economy. Our fundamentals are still good, and our labour market. So the idea here is to look at how our GDP progresses, our private consumption, our labour market conditions, and among others. There's just so many variables to look into, but these are the key ones that we look at as well.
Any further questions? We got Lokman Datania from The Age, we got Ishin from Sinchu. Maybe Sam, you have a question? Tak ada? Or maybe Faika ke? You have any questions? Tak ada? Pranama? Okay. Faidu, maybe you want to have a summary or wrap up before we close? Oh, ada. Lokman ada soalan lagi. Yeah.
Just the last one, second and last one. What do you think will be the biggest challenge for the markets and also for the Malaysian economy for this year? And then, from your standpoint of view, what do you think that what Malaysia should be the positions in terms of new administrations of Trump 2.0, because now they also targeting not just China, also included Mexico.
Okay. So there are two parts of your questions. One part is about Trump, and the other part about the biggest challenge. Okay. Let me explain about the first part first about Trump. Now, Foreign Minister Dr. Sri Muhammad Hassan yesterday mentioned that the cabinet will deliberate about Trump, or rather about the conditions that that will come in 2025. And I think that, I mean, if I were to look at it in a different perspective, is that while we saw what happened in Trump 1.0, and then, and I think the idea here is perhaps to look into the overall picture about how the US economy proceeds from, in the new administration. And it's not just going to be us responding to every piecemeal basis of the new announcements, but rather to take a broader view about how we look into addressing the change in policy shifts coming from the US. And we saw that we saw this kind of scenario back then anyway, where we think that the government were very clear about their position as to that there will be spillover of investments as a result of the realignment of US policy Trump 1.0. So I think today they will probably take the same manner as well to look into a broader perspective and an overall picture and to see how things will unfold, or rather where the policy should be in the next couple of months or even years. Now the second challenge about Malaysia, you say?
What will be the biggest challenge in 2035 for the market in terms of the Malaysian economy?
Well, the challenge for the market, I think, is to keep up with the announcements. There will be a lot more announcement that can move the market, unlike what we saw in the past. So it's not just about data-driven market-induced kind of news, but also maybe announcements that can feed into that narrative as well. So I think the way to address that challenge is just to stay very vigilant and to keep an eye about what the pulse of the economy really is, and perhaps it's also to understand that there are things are not going to be in a straight line. Although we present our report to say that okay, we'll trend flat, it will stay at like for example like US dollar, we look at 445 by the end of the year, but it is not going to be a straight line. There will be variations. So that variations will come to a lot of data, a lot of announcements, and to keep up with that is going to be a challenge for me and my team, and as well as all other economists as well, and together with you all, because you all have to feed us with information too. So I think that's probably the biggest challenge also.
One last question for me.
Sure, go ahead.
So I checked for the report mentioned that in the near term, Malaysia expect will continue to benefit from temporary boost of the front-loading activities ahead the tariff hike. But what's your long-term view on maybe the export and also because I think like China economy is also one of the problems. And how do you view like our relationship with China, because we are close relationship with China? Does it mean if anything happen with China economy will like happen to our economy too?
So okay, like I said, there are lessons learned from 1.0, but it is not going to be a carbon copy of what happened during that time this time around. So again, what happened during Trump 1.0 is that China slapped the tariffs, but our exports to the US remain consistent on the upward trajectory back then. So we think that while the US continue to be resilient with the economy thanks to the conditions of the labour market, we think that Malaysia's exports will continue to benefit from that as well. And besides, if you break down into the components, or rather the export markets of Malaysia, we notice that the exports to the US is the one that is robust among all of this. But then again, we do not think that China is going to be severely affected or badly affected in this time around compared to Trump 1.0. But then again, it all depends on the coming announcements coming from the US. But we don't think it's going to be a carbon copy of whatever happened in Trump 1.0.
Okay, if there are no more questions, thank you so much, Chief Firdaus Rosli, our Chief Economist. A round of applause for you. Thank you. Thank you for the very insightful presentation. And on behalf of AmBank, thank you so much for your presence. We're so delighted to see a very good, almost full media turnout. Maybe still not too late for us to wish you Happy New Year 2025, and in advance wishing our Chinese friends as well, Gongzi Pak Chai, for the